Put your hand up and ask a question. If you have questions in the Zoom, please feel free to raise your hand and we can put you into the room with us, or feel free to drop them in the chat and we'll answer them anyway. So thank you very much, and over to you.
So, hi, my name's Lucy and I'm one of the tax specialists at Henderson Loggie. Jaslyn will come and speak to you a bit in a minute from the accounts side and the business side. So hopefully what we're going to do today is get the slides to work.
You can just press
there we go. Yeah, basically talking to you about setting up as a freelancer, the different ways you can set up. And I think what I'll start by saying is obviously it can be scary and it's a pain in the neck. And I think admin's not nobody's favorite task, but it doesn't have to be too complicated. It doesn't have to be that onerous. And if you do get it set up well at the start, you basically make it nice and easy as you go forward. If it's not, and it gets into a mess, that's when it can be really quite onerous to get it all sorted out. So hopefully we give you a good enough overview today that you can make it easy, but also, as you said, ask questions. We're happy to answer any as we go along, either that are in the chat box or live if you want to ask anything. So if you're a freelancer, there's essentially 3 different ways that you can set up. You can be a sole trader, self-employed, lots of different ways, terms for it. You can be a partnership. A partnership is essentially just more than one sole trader working together. So if you're running your business with someone else, that would then be a partnership. That's a simple way to set up, is either a sole trader or a partnership, being your sole traders working together, or you can set up as a limited company. And the main question that we get asked is, what's the advantages and disadvantages of all of them? The simplest is a sole trader. It costs you really nothing to set up. I'll come on to that in a bit more detail. But really, this is just to give you a bit of an overview on what the differences are, in case anyone does sort of think that they would rather set up as a limited company. So is it a separate legal entity? The answer is, for a sole trader, no, it's essentially just you. You can have whatever name you like. It can just be your own name. You can make up whatever business name you like. It doesn't matter if someone's already got it. You just set up, let Hmrc know, and that's it. A partnership or a limited liability partnership, they're both taxed the same way, and in Scotland they are technically a separate legal entity, but as far as the tax, which is probably the important bit, what you actually pay, it's the same as if you were a sole trader. A limited company, absolutely, completely separate to you. And limited liability, I think that's probably the main question that we get asked. What does that mean? It means if your business goes badly, and hopefully that's not going to happen, that's not why you're setting up. You're setting up to do well. If it went badly, then you could potentially be liable for the debts of your business personally. That is limited if you're in a partnership. Well, in a limited liability partnership or a limited company. Tax transparent for all the partnerships and sole trades, yes. All of the profits are taxed on you as an individual. A company, tax transparent, no. So the company is taxable. The company pays its own tax. You would only pay tax on what money you draw out of the company. So there's quite a distinction there. All of them really need some form of accounts, and I'll let Jaslyn come on to that in more detail. Accounts for a sole trader or a partnership, they're your own private business. The only other person that will see them is Hmrc, unless you've got someone who helps you put them together, like us, like an accountant, then it would be you, your accountant, and Hmrc. No one else ever has to see them unless you choose to show them to them. Banks very often would ask, but it's entirely at your discretion. If it's a limited liability partnership or a company, those would be available on Companies House. So again, probably not a big disadvantage, but just something to be aware of. Some of these other ones, Loss relief against personal income. If your business, a lot of businesses take a couple of years to really get going, you might have some losses, a lot of setup costs. If you're a sole trader or partnership, you can offset those losses against your other income. That can be really useful when you're setting up because you've not got an awful lot of other income, reduces your tax liability. For all of them, you have to register with Hmrc, and I'll come on to how you do that. You only have to register with Companies House for the limited liability partnership and the limited company. And you're required on an annual basis to file those accounts with Companies House. And a personal tax return is required for all of them. If you've got a limited company, you'd also have a corporation tax return. So you need a set of accounts no matter what. You need a personal tax return no matter what. And if you're a limited company, you also need a corporation tax return. But otherwise, it's pretty similar. It's really just the actual filing requirements. So as I said, the most simple way to set up is a sole trader. I think for most people starting out, it is where they start. So how do you set up as a sole trader and what are the tax implications? It's income tax and national insurance, basically the same as if you're employed. The only difference is that when you're employed, the employer takes the tax and national insurance off before they give you your money and they pay it straight to Hmrc. As a sole trader, you'll be responsible for calculating how much tax and national insurance is due and then paying that over to Hmrc. The good news is a lot of the systems will actually do it for you. So no one's expecting you to sit and calculate and know all of the tax rates. Either you can get someone like us to do it for you, or there's great software. I know a lot of people who do their tax return by just putting together the income and expenditure in a fairly simple format, and Jaslyn will talk to you a bit more about that. And then they use the Hmrc online software, and it pretty much takes you through which box to fill in. And there's lots of help. You know, we help some people by doing everything for them and other people just by assisting them with that initial process. So there's lots of different ways to do it. I think the key thing with a sole trader, and something that people sometimes go wrong with in the early years, is that you're taxed on all of the profits. So your profits are all of the income less all of your allowable expenses. And that's regardless of whether you actually take the money out of the business. So some people say, yes, but I didn't take all of that money out. I left it in the business account because I invested it into the business the following year. That doesn't matter. You take what's income you've had within that year, less the allowable expenses, and that's a profit, and that's what you're taxed on, which can seem quite unfair when you need to reinvest that in the business for the following year. And again, probably something that we'll cover a bit later on as well, but just to say it here, when you do start up, it is worth just as the income comes in, thinking, oh, I'll just put a little bit aside, and then I know that when it comes around to it, I've got enough to pay tax. If we're talking all there about profits, if the income comes in and actually the expenses are much higher, there isn't a profit, you've got a loss. The good news is no tax to pay. You can either offset that against other income and have got other income within the year, or you can carry it forward until your business starts making a profit. That's the most common one if you're setting up as a new business. So that means first year, maybe 2 years, you've not got a profit, you've just got a loss. Year 3, you make a profit, but actually those losses, take that down so there's still no tax, and then you start paying tax after that. So it's always worth keeping that in mind. When you're a sole trader, a lot of the expenses you'll have might double up as personal expenses as well. So if you're working from home, obviously you need to live in that home. Lots of those are your personal expenses. Your home is not just for your business. You sleep there, you eat there, entertain your friends, all of those things, and you work there. So you would basically take a percentage of the household costs that you could set against your income as an allowable expense. You couldn't set the whole lot against. If you have a car, sometimes you use it to go and do business errands. but sometimes you use it to go and do all of the other things that you might like to do. Then you work out how much of the car you use for business, how much of the time, how much is personal, and the percentage business can be put through. So that's quite a big difference from if you were operating as a limited company. There, it's either an allowable expense or it's not. If it's got an element of personal, very often the answer is no. So you've got a lot more flexibility as a sole trader there. And there's a personal allowance. So again, you may be aware of that. Every individual has a personal allowance. At the moment, it's £12,570. So that basically means the first £12,570 are tax-free. So it's only the profits over and above that that would be taxable. How do you register as a sole trader? So you basically register with Hmrc. So if you go along to the gov.uk website, and it is, sorry, I think we've lost the www dot, but www.gov.uk website, and click on self-employed or sole trader, it'll take you to the link where it says register, fill in a few details, and that's you registered. It's as simple as that. There's no cost to it, and there's no legalities. There's nothing really complicated that you need to do. There is a deadline technically for registering, and that is the 5th of October, following the end of the tax year in which you started. So if you start trading today, the tax year runs till the 5th of April next year. So the tax year runs 6th of April to the 5th of April. So if you started today, tax year will run till 6th of April 2023. So you would have until October next year to register. If you started your business before April this year, you've got until, what's that, 2 weeks now, till the 5th of October, about that, 2 weeks to register. I've been in tax for, let's say actually it's nearly 20 years now. I've never seen anyone fined for not registering on time. So as long as you register, as long as your first tax return is on time, that 5th of October deadline is a bit of an arbitrary one, but the main point is go onto the gov.uk website, pop in your details, and that's you registered, and then you submit a self-assessment tax return. So the tax return is the important bit. The tax return is due by the 31st of January following the end of the tax year. So if you started trading before April this year, before the 5th of April, you would work out all of your profits from the day you started trading up to the 5th of April 2022. And you would have to submit that tax return by the 31st of January 2023. If you started today, you would work out all of your profits from now until the 5th of April 2023, and your first tax return would be the 31st of January 2024. Now, I will say, you don't have to leave your tax return till January. I have a lot of clients who like to, so I don't really sleep in January, I just work. You can actually do your tax return on the 6th of April if you really want to. So you just go online, fill it all in, it's done, and you don't have to worry about it for 9 months through to the 31st of January. And it doesn't change the date that you're due to pay the tax. So the tax and the tax return are due by the 31st of January. But if you do your tax return in April or May or September, whenever you want to, it doesn't change the fact the tax is not due till the following January. So a really good way of doing it. You sit down, you get it done April, May, you know next January, that's what your tax bill is going to be. And it allows you to save up for that in plenty of time. If you do your tax return beginning of January, and it turns out actually you've got quite a big tax bill, you've only got a month to pay it. So yeah, having been in tax for a long time and spent a lot of time in January doing tax returns for people, I'm always going to encourage people to do it a bit earlier than January. And the main thing for doing a tax return is that you've actually got all of the records that you need to do it, because if you don't have those, it makes it very difficult. And you've got to work back through everything and try and work out what you've been doing for the last year. So I will hand over to Jaslyn, who's going to tell you how to keep your records and why it is so important.
Hi, everybody. Well, first of all, as Lucy said, kind of once you've decided on your business structure, which for a lot of freelancers is that sole trader, you're pretty much ready to go. And it's an exciting time. You want to grow your business and you've got a great idea and you can't wait to get started. But there's a really frightening statistic that 40% of businesses fail within their first 2 years. And it's not because you don't have a great idea and that you don't have ambition or clients or any of that. It's all about planning. So once you've registered, it's really important to get those foundations right. And part of those foundations is making sure that you get your finances in order and keep proper records right from the outset. I thought it was quite actually telling when Lucy just said there, make sure you get your tax return done on time, because I'm an accountant and I leave it to January every year to do my tax return, which is horrendous. And every year I say I'm not going to do this, but we'll come on to reasons why actually now I can't wait till January. But I just thought it'd be really important, first of all, just to touch on why it's really important to keep those records up to date. So first of all, you want to know how the business is doing. So if you wait until it's time to complete your tax return, you've got no idea if you're growing or not. So as Lucy said, you want to know that hopefully you're making a profit. Hopefully you're making enough money to cover your costs. So it's really important to know how your finances are doing. And that is not just checking your bank balance. So making sure that you have the right records is really important. It also helps you stay organized, depending on the type of business and what you're doing. I would imagine you'll be invoicing some of your clients monthly. If you're not on top of your books, how do you know if your clients are paying you on time? So it's really important, again, to make sure that you're tracking, that you're sending out invoices timely. It makes you look professional. It's hopefully give you repeat business, but also tracking when that money is coming in as well, just to make sure you do get paid on time. And that allows you to then pay your suppliers on time. It also makes preparing management information much easier. And quite often, depending on where you are in your business, you might need to get investment, whether that's a loan from the bank or thinking about someone else coming into the business, another partner or investors if you're a company. Again, making sure that you have up-to-date financial data is really important because they will want to see that information. So again, from a professional point of view, it looks really good if you can have that information at your fingertips. And as Lucy said, it also really helps with tax planning. There is nothing worse than leaving everything to the last minute. You're lodging your accounts or your tax return right at the last minute, and then you're suddenly having to pay your tax a week later. The further in advance that you can have all this information to hand, you know what your profit is, and therefore you know what your tax is. That allows you to plan for that. It allows you to keep money aside to pay those bills, but also, is there anything else you can do? You know, is there money that you can put into a pension? Do you want to give money to charity? There are lots of other sort of tax advantages and tax things that you can get into. And really importantly, actually, for all of us as accountants, is it'll save your accountant's time, it'll save you time, and hopefully it'll save you on fees as well. So the more organized you are, that you keep your records together and hand everything in nicely to your accountant, it does really save you money in the long run. And it also avoids interest and penalties. So obviously, if you don't file your tax return or your accounts on time, there are penalties. And depending on the business structure that you decide to go with, and depending on how many times you're late, quite often these penalties can double. So very quickly, you can have quite substantial penalties for not filing on time. So it's really important. And again, if you don't pay your tax on time, then interest will be charged on that. So really important to have these things up to date. And then obviously it's the law to keep records. If you don't have them, if Hmrc were ever to inquire about your business, then you know there could be implications for that. So it's highly important. So what do you actually need to keep? So as I said, you need to keep a record of all your sales and business income. So actually, sorry, before that, what's really important, especially if you're kind of going down that sole trader or partnership route, is to make sure that you have a business bank account. So quite often you'll maybe have a personal bank account, and it might be very easy to start putting some of your business, the business income that you generate or pay some of your business expenditure out of a personal account. I would highly recommend that you have a separate business bank account. So once you have a business bank account, make sure you record all those sales. So you should be generating an invoice for every single piece of work that you do. And on that invoice should be the date, details of what you've done for that customer, and then obviously your bank details with all your payment information so clients can make payment. You should also keep a record of all your purchases or expenses that you have. So again, that might be travel receipts, it could be invoices from Amazon, if you bought computers or IT equipment, camera equipment, whatever it is, just make sure you keep all those receipts, because everything is claimable. You also might, as I say, pay for goods out of your personal account, or if you have a personal credit card, for example. Again, even if you paid for things personally, if it's a business expense, make sure you keep that because you can claim it. Lucy touched on there is obviously using your car and claiming for that as well. What you can also claim as well as petrol is claiming mileage. So you can use your personal car, and rather than claiming fuel and then eliminating a private use, what you can do is claim a mileage allowance. So that's just, you just need to take a note every time you go to a client's premises or a venue or on a business trip, is the miles between your office, which is probably quite often your home, and where you're going, and the miles that you traveled, and then 45p a mile is what you're able to claim. If you're lucky enough to receive grant funding or you have loans, again, make sure you keep all those agreements as well. So every documentation in relation to your business you should be keeping. Doesn't need to be in hard copies, soft copies are fine, just as long as it's all kept together somewhere securely. Things that you can actually claim. So all items that you can claim have to be wholly and exclusively for business. So as I say, most likely you'll have equipment, laptops that are used for business use. If you rent space or even hot desk in somewhere like this, then again, the cost of that can be claimed. As you grow, you might well employ staff. So their salaries are also a deductible expense, accountancy, legal fees, phone bills, advertising, and I've kind of touched on travel as well. So it's just making sure that things that you can claim have to be wholly and exclusively for business use. So how should you maintain those records? And this kind of goes hand in hand with what I'm going to talk about next, which is making tax digital. So there are lots of ways that you can keep your records. Back in the good old days, sole traders used to just kind of hand their accountants a bag of records with all their invoices and receipts in a plastic bag, and off you go and go prepare our accounts for you. Nowadays, there's much better ways to do it. Excel spreadsheet is one, but cloud accounting is really coming to the fore now, and there's lots of different cloud accounting packages out there. And I do recommend that as you start to set up in business, you think about getting a cloud accounting package. There are certain benefits to that. First of all, it just gives you that access to that data anytime, anywhere. It's all stored in the cloud, which means you can store all your invoices there, so you're not having to worry about keeping receipts. It's actually very easy now. You can just take a photo of the receipt and upload it up to your accounting software. So all your data can be kept in one place. You can also link your cloud accounting to your business bank account. So it actually downloads all the information into your cloud accounting package for you. So you're getting that data in real-time information. So very quickly, the use of the AI technology allows you to build up a picture of, as Lucy said, what your income is, what your expenditure is, and what hopefully your profit is. So very quickly you can get that data. Also, most cloud accounting packages now are all what we call MTD compliant, so Making Tax Digital compliant, and I'll come on to that in a second. It's really cheap. I think the cloud accounting packages, so they start from around £26 a month, which depending on your mobile phone package is probably cheaper than your mobile phone rental. So something I think really worth investing in. You don't need to have backups. Everything is on the cloud, so it's easily shared with colleagues and also your professional advisors. And also over time, as you grow, there's lots of different apps out there which you can link to your cloud accounting package. So again, everything's kind of reducing your manual input because, as I said at the beginning, the most important thing that you want to do is run your business and help it grow. And you do not want that admin burden that Zoe mentioned at the beginning. So cloud accounting really does allow you to stay on top of things on a day-to-day basis, but in a really, really user-friendly way. And linking to your bank account means that there's so much of it is done automatically. There's less manual input required from yourselves. So I talked a bit there about Making Tax Digital, and some of you might have heard of this. So Making Tax Digital is an initiative that's been brought in by HM Revenue and Customs to digitalise and simplify the way in which we report financial information and how we pay our tax. So a few years ago, MTD for VAT came in. So any business that was VAT registered had to start submitting their VAT returns digitally through MTD for VAT. And now this is the second stage of Hmrc's MTD journey. So from the 1st of April 2024, which might seem a while away, but not that far, MTD for ITSA, as it's called, comes into effect. So ITSA stands for Income Tax Self-Assessment. So from 1st of April, anyone who is self-employed or a landlord with gross income of over 10,000 will need to sign up for MTD for ITSA. There are plans going forward for partnerships and limited liability partnerships that Lucy touched on earlier. They will follow suit in a few years' time, but those dates are yet to be confirmed. But for those of you who are freelancers, who are self-employed, then 1st of April 2024 is when MTD for ITSA really comes into effect for you. So what does this mean? So what it means is that your accounting your accounting records now need to be kept digitally. So we can't have those bag of books. We could have spreadsheets, but the best way forward that we recommend in terms of your digital journey is to make sure that you keep your records on a cloud accounting package. So you have to do that. And now, whilst Lucy said, yes, you do have to submit your tax return on the 31st of January every year, you also have to make what we call quarterly submissions to Hmrc. So now every quarter you have to report to Hmrc on your income and expenditure in that quarter. So the quarters are, I suppose, from the 4th, because obviously our tax year is 6th of April to 5th of April. So it would be the 6th of July, is that right? October and January. But we can do it. Yes, to keep things nice and simple, you can also do it in calendar quarters. So it would be 30th of June, September, December, and then January. So you have to submit digitally your income and expenditure every quarter to Hmrc. And at the moment, that is purely just a reporting requirement. You don't have to pay your tax at these times. It's just report your data. Helpfully, HMRC will then tell you roughly what your tax liability is. So at least you can start doing that tax planning part. So you do your quarterly submissions, and then at the end of the year, you will then do an end of period statement. So that would be to capture anything that's been missed in these quarterly statements, or quite often, say, for example, you do have equipment that you maybe depreciate over time. So what we call kind of these year-end accounting adjustments would be brought in the period end statement. So depreciation, if you've got any costs that you've actually paid for after your year end, but they actually relate to the year, you'd put them in. So anything that's not on a cash basis, really, you would do your period end statement. So you do that, and then you then file what they call the final declaration to HMRC, which is very similar to a self-assessment tax return. There's kind of 6 now submissions that you have to make to HMRC. But as I say, in terms of your tax payments, that remains 31st of January and 31st of July each year for now. But it is likely that in time that will change, and you might have to pay, you will be making tax payments throughout the year. That's it, really. So I suppose on that rather depressing note. Yep.
I consider positive to once in the year. So gross income, does that mean it's 1/3?
Gross income is normally turnover.
And then someone said, I do have a wee question around working with international print on the Allowance sites. Example, Redbook. They seem to take tax in the US for paying their artists. How does that impact taxes in the UK? I feel like maybe Redbook shouldn't be taxing international artists, because then we as the artists are paying tax twice. Quite a specific question of advice.
I would say with that one thing is probably to make sure that you are taking tax advice on an individual basis. So I can give you a sort of general overview, and that is that where services are carried out in other countries, then they do reserve the right to tax income that's essentially arising in their country. But wherever you've got, if you're based in the UK, so if you are a UK resident, you're taxable in the UK. If you've had tax taken off at source in other countries, then you would include that in your UK tax return. You get credit for what tax has already been paid. So, I mean, I'm saying that I think 90% of the countries around the world, we have a double tax treaty with. As long as there's a double tax treaty, you get credit for the tax that's been paid in the other country. Certainly if it's the US, we do have a double tax treaty with them. You'll get the credit for the tax that's already been paid, which should mean that you're not paying tax twice on the same income. It does, however, mean that whichever country has the highest tax rate on that income, that's what you end up paying. So I think where you've got tax in more than one jurisdiction, make sure that you are taking good advice on that, to make sure that you're not paying more than you should.
Yeah, our grant income is that part of your taxable income. Then yes, if you received state aid funding, so grant funding, then that does count towards the 10,000 income. Yes.
There are occasionally grants that are not taxable, but most of them are. So the grant is for the income, is for the assets to help you set up.
Can you repeat my questions as well into the mic?
Sorry, yeah. asking whether, because the grant's for assets to actually set up the business, is that correct? You're investing in things to set up the business, and that's what you've got the grant for. No, you were asking if the grant was taxable.
Zoe, would you be able to say the questions into the mic as well? It would be a little bit clearer online for me.
Yeah, sorry, we're just trying to clarify exactly what the question is. So it sounds like we've got here a capital grant rather than an income grant. So yes, the question is a capital grant taxable? And the answer would be very often no, it's not. But it can limit the expenditure for what you use it to pay for. You might then not get tax relief for that expenditure. Basically, you can't get relief twice, essentially. So if you're getting a grant to help you pay for the capital investment, then you wouldn't then get tax relief for that capital investment as well, because it's not your money that's essentially paid for, it's the grant.
And if it's, sorry, I was going to say, and if it's a revenue grant, and it's used for just general costs, again, that grant income counts towards that 10,000 of your MTD for ITSA. So it is income, but obviously you're likely to spend that during the course of a year. So any profit that would be taxable, I suppose, on it, depending on what tax year in which you spent it. Yeah.
What are they going to be very similar to how we do it just now, or is it going
So you can do it on a, so, oh yeah, sorry. So what do the quarterly submissions look like? So it will be a simple, it'll be a list of your income, so your total income, and then a list of what your expenses are. And then a total profit or loss at the bottom. So it won't look like it's not a it's not a return, it's not a particular format, I suppose, or it's just what we call an income and expenditure account. So you could do it on a spreadsheet. You don't have to use software, but then you would need what we call bridge. You would use you need a special kind of connection to your Hmrc account to then digitally put that in. So you can't manually.
You could just like.
No. Mm-hmm. There has to be a digital connection between, yeah.
So some questions, quite a lot of questions online. So one question is same question as above. So the red bubble question, but for Etsy, they take 20% before paying artists. How does this work for tax returns? So Etsy, the selling site, take 20% off any income that the artists make.
Do we know where Etsy are paying the money to? No.
Online. I'm not sure.
I suppose basically.
Oh, so that's just commission, not tax.
Right. So that's just an expense. That's one of your expenses against the income. So you would include the total income in the income box, and then you would include the 20% commission that they've deducted, so that you're only paying tax on the net.
Okay. So I have a question for something mentioned before. If working from home, how can we decide what percentage of our utilities goes into the business and what we can pay back as an expense?
There's two different ways to do that. The very simple one is a flat rate. So at the moment, that's £312 per year.
So this
Sorry, yes. So the question was, how do you work out what percentage of your home costs that you can claim against your business profits? So there's two ways. Yes, either a flat rate, which is £312 for the year, which is nice and easy, or it's a percentage of all your home costs. You've got to work out either your rent, or if you own the property, mortgage interest, not the whole mortgage payment, only the interest, gas and electricity bills, council tax, are probably the main ones. I'll come on to your broadband internet in a second, but those ones are the home costs. And then you work out how many rooms you use out of the total number of rooms in the house, how many days out of the week you work. I think for that one, there is great guidance online on the Hmrc website, or ping an email to one of us and we can just send you a quick thing giving you the details of how to work it out, rather than trying to all write down number of rooms, number of days, number of hours. But generally speaking, you would expect that percentage to come out somewhere between 7 and 20%, depending on how big or small the house is.
That's the follow-up question, because I was never told about the first option. I had to work everything out in percentage and using that for years. So where does this 312 per year come from? Or is that figure, is that something like that you like your company has come up with, or is that
No.
No, so sorry. The question was, where does the flat rate come from of £312? There's actually a number of flat rate expenses that Hmrc have released for years on what are acceptable amounts to claim for certain things. A lot of them are actually also available if you're employed. So the 312, it was basically a flat rate per week. It was quite highly advertised over the last couple of years through COVID, because obviously everyone, even employees, were suddenly working at home. So that one's been slightly more well advertised by Hmrc, but there are a lot of other ones, flat rates for various things that you can claim. So it's always worth having a look.
You find that on the Hmrc website.
Yes. Sorry.
delving through their website to try and find it?
Yes. The use of home one was actually on their sort of homepage for a wee while. I don't think it's there now, but it's not too difficult to find. But if you just go to the gov.uk website and type in flat rate expenses, then you should get a list of all of the various things that might apply.
So there's a question on the chat of my concerns. That's about this. So what if you paid on the mortgage? So what's the percentage of your home now? Attract the council tax?
Right. So will it attract council tax at business rates? No. As long as you are not using a room in your property solely for business, absolutely for nothing else. I think for most of us, we don't have homes big enough to do that. Certainly for me, my home office is also the spare room. It's also got a bit of gym equipment in it. On the rare occasion I exercise, you know, it is multi-use. I think that's probably the same for most people who have a home office. Even if you've got a friend who stays in that spare room once in a year, it has another use. Therefore, it is not sole business use. It doesn't affect the council tax. And the other question you normally get asked on that is, would it affect my capital gains tax if I ever sold the property? Because it wouldn't be solely my principal private residence. Yes, it is, unless you have said that room is solely for business and nothing else. It doesn't affect anything. So as long as you've got a couch or a bed in the corner or something on at least one day of the year, then that's fine.
Great. And does it affect if you paid off your mortgage?
It just means if you've paid off your mortgage, there isn't anything that you can claim in respect of the mortgage. So it would just be your council tax, gas, electricity. And I did say I would come back to the broadband, didn't I? So broadband, I would generally keep separate. Because I think we generally use the broadband a lot if we're working from home. That's one of your main tools, especially if you're working a lot online. So I would expect the percentage for that of business use to be much higher. You may feel that that's sort of 50% business, 50% private, depending on how much you work from home. If you lump it in with the rest of your home expenses, you'd only be claiming sort of somewhere between 7 and 20%. So pop that one in as a separate expense.
Yeah. So if you paid for business expenses personally, how do you account for them through your accounts? Well, to be honest, you don't need. I mean, proof is purely just in the receipt. So as long as you've got a receipt, it doesn't matter that you've paid for that personally. You can still put that through the accounts, and then I suppose the amount owed, it just goes through as what we call drawings. As a sole trader business that you have, a limited company. All right, okay then. So that's regarded as a director's loan. So you have paid for something, so that money you are owed back to the company at some point in the future. So yeah, it's really a loan. You have loaned the company money by paying for something personally. And at any time when there's sufficient money in the bank, or you need that money back, you can just withdraw that from the business bank account and pay it back to yourself tax-free.
One question from the chat: is workplace pension included in the £10,000 limit?
No. No, workplace pension is not included in the £10,000 limit. That's completely separate. It's not part of your trading income.
So, is a percentage of council tax on my home allowable if we have a home studio? If so, how do we determine what percentage?
So how would you determine the percentage of council tax for a home studio? Basically exactly the same as you would for the use of home. You're basically saying that studio is the room that's used for business. How many other rooms are there in the house? And how much of the day do you spend in the studio? How many days do you work a week? So it's back to that same calculation. And again, making sure that at least on one day a year you use the studio for something personal, just to make sure that you're.
I suppose one of the questions is, do you think that the flat rate expenses that Hmrc obviously have on their website, are they likely to go up, given that we've had 45p a mile for ages? It's not really something I can comment on. You know, Hmrc do review their flat rate expenses. How I couldn't, yeah, we don't know, not very regularly. It has been 45p a mile for a very long time. But you never know, given the cost of living crisis that we're in just now, they may well review that, but I don't know.
Last one, yeah.
Oh, is that the last one? So the last question is, in terms of the quarterly tax submissions, if I was looking for a loan or mortgage, would I be eligible based on the quarterly performance instead of the year-end final declaration? I think depending on the loan provider, I would have expected that they will still want to know your annual income, and therefore it wouldn't be based on one particular quarter. So it would be a combination of all four, or the final year-end submission. But lenders are always looking for what is your gross income on an annual basis.
I want to ask,
Please could you repeat what MTD ITSA concerns?
Oh, right. So MTD for ITSA from 1st of April 2024 relates to sole trader businesses and landlords. So anyone who rents a property. And as I say, going forward, it will affect limited liability partnerships. It will affect limited companies, but we don't know from what date yet.
But so when it comes to working out that amount, they need to provide that information in the Hmrc to work out that figure or to
So the question was for putting money into your pension. It does depend on your earnings, how much you can put into a pension. Will that be based on the quarterly or will that be based on the year end? It will be based on the year end submission. It's what's called your net relevant earnings. So you can basically put in up to 100% of your net relevant earnings. So whatever your final profit is, that's how much you could match putting into your pension. Obviously, if that is your only income, you can't go and put all of that into pension. But that's how much you're allowed to put in, subject to other pension restrictions.
So I'm just trying to get into the question. So we have a question that says deadline.
So in terms of the quarterly submissions, yes, you can, well, you can't choose your quarter. So the quarters run in calendar quarters. So it has to be 30th of June, June, 30th of September, 31st December and 31st January. That's the simplest quarters. It could run the 5th of the month, which would be the tax year, but to make it simple, it's really calendar quarters. In terms of, yes, there is a deadline.
Yes, I think you've got 30 days.
30 days, I think, in which to file your submissions. So 30th of June, you'd have to 31st of July.
I think what we will qualify that with saying is that the actual guidance from Hmrc on this is kind of coming out as we speak. So we're looking at that every time you post an update. They have suggested at 30 days, but I don't think they've set that in stone yet. So just keep an eye on that one.
And I think given MTD for VAT, when that came in, Hmrc had a bit of a soft landing on it. So there was no penalties, you know, if you didn't submit on time. So I would imagine with MTD for ITSA, there might be a similar soft landing as well for a period of time. So Madeline's asked, when we start doing the MTD for ITSA, will we still need the accountants as well? The cost of cloud accounting looks like it will be about the same as your accountant's fee, as my accountant's fee. I think it's, you know, I think it's up to you. It's like kind of Lucy commented in the beginning, you know, your accountant can do as little or as much for you. I mean, cloud accounting is a really good package. And given that at the moment, all you're having to do is submit quarterly income and expenditure statements, that can be done by yourself. You don't need an accountant to submit it. So if you think that you can do it yourself and you have the time to do it, then yes, do it yourself. But, you know, if you're very busy and you're not, you know, you're not inclined to do that, then your accountant can do it for you. So I think it's a really much a personal circumstance.
And can I just add to that one? It was just one other thing I was wanting to mention. It probably falls into that. I think with all of these software, they're very good at keeping you on the right track with all of the main expenses and things that you can claim and what you can and can't put through, but they're not always going to be up on the changes and some of the more unusual things. And one of the more unusual things for some creative businesses is that you can actually average your income over a couple of years to try and average out your tax liability. So if you have a really good year and a really bad year, some creative businesses can average the two so that you pay a slightly lower amount of tax in both years, if perhaps one's in higher rate and the other one's you've barely used your personal allowance. You basically spread some of the income into both years, use your personal allowance in both years, it lowers your tax, gives you some tax savings, and evens out rather than big tax bills and then nothing. So not every creative business is eligible. So for something like that, you know, make sure you go and get a bit of advice around that if you think you might be eligible. And I think sometimes I've got a number of clients who do their own tax return every year, they do their income and their expenditure, and they put it all into HMRC, and they come to me every few years, maybe every second year, every third year. We just have a check-in. Are they claiming everything that they can? Is there anything they're claiming that maybe they shouldn't? And is there anything else that they should maybe be thinking about? Should they be thinking about putting some money into their pension? Would that give them a tax saving? Is that just good financial planning? And I think for Jaslyn, if people come to you, you can also help them sort of look at their business. I think Jaslyn had a lot of good points in that first line about why you keep the records and be able to look at how you're doing through the year, even for just getting advice and saying, actually, are your fees a bit low? Are you charging your clients enough? I think that can be quite useful advice to get. So doesn't have to be every year, doesn't have to be us doing everything, but I think sometimes just coming and getting some advice.
Another question on the chat that was way further up. Regarding quarterly tax submissions as of 2024, if I was looking for a long-tax mortgage, if my eligibility is based on quarterly per business.
So that was the one about they're looking for a mortgage or a loan. And then, again, so if you're looking for a mortgage or a loan, then the income wouldn't be based on a quarterly submission. It would be based on the year-end submission, because it has to be based on your annual earnings. It's, depending on the lender, they might look at a quarterly submission and then annualize it, but it really does depend on the lender. And also, again, I suppose as Lucy commented there, it depends on your fluctuating levels of activity. So I think they'd want to see some history there. Okay, second last one. I'm just starting, and I know that as an employee, some of my taxes go for a pension fund. How does that work as a sole trader? Should I just save up on my own, or some of the taxes I pay cover that?
Yeah, so for a pension, if you're a sole trader, if you're paying your class 2 national insurance, which you generally have to pay as a sole trader, then yes, you're contributing towards the state pension. The state pension is not big. So contributing to a personal pension is always advisable. It may not be something that you can afford to do in the early stages of a sole trader. As Jaslyn said, sometimes that first couple of years is very difficult. You need every penny just to keep reinvesting and keep the business going. Keep it in the back of your mind. As soon as you think it's feasible, have a look at setting up a personal pension, and then you can contribute to it as and when you want. And there's great tax relief for contributing to a pension. But yes, otherwise, and I think the question in there was, could you just save up out with a pension? Well, if you put all of that money into a savings account, they'll tax you on the interest. If you put all of that money into a pension fund, HMRC will add 20% to whatever you put into the pension fund. So you've already got a win there, and all of the growth will be tax-free. So has a disadvantage in the pension that you can't access it till you're 55, but that's also an advantage. It stops you spending it, and means it is definitely saved for your pension. So.
Because it seems like everything is still kind of using
As I say, I think the benefit of the quarterly submissions is really just a starting point. I mean, what HMRC are trying to do is there's an argument that some of the things that have been submitted by paper annually, it's quite easy to make mistakes, and therefore there can I suppose payments of tax can be missed because maybe you've not put enough zeros on your, on your tax return. So digitalizing it, and the fact that they want to see the digitalization from like raw data. So your first port of call, so from invoices, and they'll be able to track that through. So they see it as the more that can be digitalized, the less errors in these submissions, and therefore the tax will be more accurate. So that's part of it. Secondly, obviously we're starting off with these quarterly submissions, and all it is a submission. But I think over time, what they will want to do is they want you to pay towards your tax quarterly. Therefore, they are getting revenue sooner.
Yeah. I think for that, they'll bring in the sole trader and the landlords a couple of years later, or 3 or 4 years later, they'll add on the partnerships. And then once everything's working, then they might start to bring in the tax payments. So I think it's part of a larger plan rather than it's making sense right now. Yeah.
Yep. Will the cost of the cloud accounting package be tax deductible? Yes, it will. So your cloud accounting package is deemed a subscription that is needed for your business. So the cost of that would be tax deductible. I suppose the question is, why are they doing this? Why are they making us pay extra for digital accounting and tax advice? I suppose again, as I say, it's part of HMRC's grand plan to make us a more of a digital world, to reduce errors and to eventually get us paying tax on a more regular basis. So getting businesses to pay tax on a regular basis. Obviously, employees pay tax every month, so it's getting businesses to do something very similar in the future. Do we know, will partnerships need to do quarterly submissions initially? It is likely, but as I say, we don't know that yet. I mean, partnerships, I think, will come in to the regime. That will be the next step, but we don't know when that is, and we don't know what that will look like yet.
Very much. Oh, thank you very much. Thank you, everyone. So thank you, Jasmine. Thank you, Lucy. Sorry, I'm just coming here so online can hear me. Hello, online. Online, do you still have questions? Oh, there are still questions online. Will quarterly tax submissions therefore demand quarterly tax payments?
Not yet. I think it will come in as part of the grand plan, but there's no date for that yet.
Okay, so thank you, SC, for asking that question. There's no date for that yet. So thank you. That was, I don't know about you as a self-employed freelancer. I will be turning to these guys way more often. So after today, we will share this recording with you. So if there are things that you missed, or just things you want to sort of like remind yourself of when you are doing your taxes, you can rewatch this. But I will also share the details for Henderson Loggie. Please do get in touch with our great accounting people, great accounting firm, and great people, as you can tell, and are ready to help. So please do reach out to them. Thank you for all the great feedback online. You're getting loads of great comments, ladies. Thank you, Nicola. Thank you, everyone. Thank you, online. So yeah, just a reminder, we are going to run these surgeries probably monthly. Next month, we're running a legal one, which is going to be talking to you about how and what you should be setting yourself up as. So all the legal structures that exist in the world. The Eventbrite will go online next week, so you can register. Again, it's another free event. If you are a Creative Edinburgh member, you will find out about these events super quickly through our newsletters. So do register. I will keep saying this till I'm blue in the face. We also have quite a lot coming up in the next month. So we've got a panel event talking about creatives in an era of climate emergency. So what can we be doing to be more sustainable within our practice? We also have creative circles at the start of October, and that will be focusing on mental health. So what can we be doing as people who work alone a lot? What can we be doing to stay on top of our mental health? And that will be online as well. loads and loads coming up. I'll send everything in an email after my holiday. I'm going on holiday tomorrow, so you can enjoy my emails as of next week again. And just one last reminder to online and the 5 people left in the room, that we have our awards at the moment. Please nominate anyone and everyone. We want to hear from everyone in the city. If there's someone you think deserves an award for something and be recognized, please do go online and submit a nomination. It takes 10 minutes to do so. Well, unless you, it might take longer. Depends on your life. So thank you online. Thank you, ladies. Have a lovely evening, and we'll see you soon. Thank you, everyone. Bye. Okay. Great. I can switch this all off now. Thank you, everyone online. Goodbye. Goodbye, online world. There we go. Oh.